Welcome to Grain IQ. I'm Chad Moyer. Grain marketing is a critical piece in keeping your operation profitable. Grain IQ is a joint project between the Nebraska Rural Radio Association and the Nebraska Soybean Board. On today's episode, we explore the weekly Commitment of Traders report and how it impacts your grain marketing plan. This is part 2 of our conversation with John Payne at Advanced Trading. If you missed part 1, we invite you to start there. That's where we talked about the funds, which is the groundwork for today's episode. We want to get back to this idea of the Commitment of Traders report because we have referenced it a couple of times here in this episode. So I guess give us explain what that report is. What is the content of this weekly Commitment of Traders report?
Okay, so as I mentioned a little earlier, and I'll recap that, sorry to double up on this, but every week on Friday after the close, I think it's 3 o'clock Eastern, but it might be 3 Central. You're going to get, especially go to Twitter, go to Rural Radio, go to anybody who's online, and they're going to quote the Commitment of Traders report. Is released by the CFTC. They're the regulators of the commodity exchanges, and they will essentially give us the position or the net position, and then they'll give us the aggregate as well. So they'll say the funds, and we'll call them the managed money. The managed money has 300,000 long corn on and 150,000 short corn. And that means that their net position is 150,000 long. You with me on that so far?
Mm-hmm. Yep.
Okay.
Math works so far. Yep.
Yeah, the math works so far. So that position is a survey taken by, and I don't want to quote unquote large traders, but once you hit a certain level, you become a reportable trader, and those traders are aggregated on the Tuesday prior. So on Tuesday's close, the survey is taken, and it's not taken with the folks who are trading. It's taken with the folks who are doing the bean counting, the FCMs, and they will report to the CFTC these positions in aggregate. And then 3 days pass, trading will happen over those 3 days. So the trading moves, but then we get the report. So it's not an accurate report as of the Friday close. So that's something to keep in mind. And as I mentioned earlier, we're getting a net position a lot of times in the headlines, but you can track the aggregate as well. And a lot of times I think the aggregate might be as helpful as the net, because I like to know when the speculators are zero. Because when the speculators are zero to the short side, that to me raises a red flag of, hey, everybody's on one trade here. And, that can go for a while. But I've been doing this for 17 years plus, and I've always kind of come to the fruition that everybody in one boat's going to sink. It just takes a certain story or a dynamic to change that. So that's what that Friday report will generate.
And they do that for all commodities, right? Obviously, we're concerned about soybeans, corn, wheat, and the major crops, but they do that across all commodities, right?
Absolutely, all of them. From even the ones that don't have a lot of speculation, cheese, and there aren't a lot of managed money in those positions. And then you look at a market like cheese, for example, or whey protein trades. There's no liquidity there, so that's a good example of where the managed money helps. If you want to trade cheese, you have to sit there and wait for the buyers from a co-op to come in to sell. You're not just going to be able to go walk up to the window and say, hey, I want to sell the board like you would in corn whenever you want and get a good price or a liquid price. That's where the fund money can help bring in that kind of liquidity to help sell to. And farmers, I hate to tell you this, you guys are speculators as well. If you aren't short all of your crop on the board or sold already out on cash, you are long. So you have to find somebody to sell to. If you felt like, hey, we're at $8 corn here, I don't want to be involved anymore. I want to get out of everything I'm going to sell for the next 2 years. Well, you need to have somebody to sell that to. And, maybe the commercials won't be the ones who want to take that bet. The managed money will. And, it doesn't matter to you. You just need that counterparty with which whom to trade. And that's what the exchanges are for.
Yep. All right. Let's talk about a couple of scenarios because we've mentioned this too. Let's just say we've been tracking this CFTC report that comes out to Commitment of Traders every week, and we've noticed they've gone from a net long, let's say they were net long, and over a series of weeks, they've gone to now net short. Mm-hmm. What is usually happening when they've gone considerably long to considerably short, John?
One of two things. You're either seeing those folks who are net long or long positions. So their bets were that we're going to go up, and they said, hey, I don't want to long. I no longer want to be long. I no longer want to have a position that's going to appreciate as the price goes up. So I'm going to sell the board. And that reduces their net position to zero. Or you have folks who are doing double that and saying, I want to sell the board now. So to sell, I have to sell two. So if I'm long one contract at the Chicago Board of Trade and I want to be short one contract, I have to sell two contracts. So that's
you have to get out of your old position, and then basically you're taking on a new position because you want to be on the other side.
Correct.
Okay.
And so that creates a kind of a dynamic that can really move the market volatility rapidly. Other things can happen with that as well. The farmers can start selling. So those commercial guys and girls who are selling their crops, they also take short positions. So the speculator who is kind of long the board starts to see a lot of pressure selling, not only from the speculators who want to get out, but they see it from the farmers who want to get out. And that's where you start to see the dynamic of a market that can depreciate really quickly. We're doing this on the 25th of June. 6 weeks ago, not even 6 weeks ago, 3 weeks ago, we were almost record long wheat. And now I would venture to say we're almost record short wheat, as we've seen that dynamic happen. Speculators got long the wheat, the market went up, and then all of a sudden farmers started to sell. And then the market started to creep lower, and then the speculators took all their positions off, and then the market started to fall, and then speculators sold, and there wasn't anybody really there to buy, because the commercials know that there's wheat coming. Why would I'll just wait for it to come to me, and I'll take maybe they're looking at the commitment of traders report and saying, hey, we're still at a net long position here. We think the board's going to go short. It usually does in July because of when the farmers sell. So let's wait. And that's what they've done. And you've seen a kind of exacerbated amount of selling here, as equaling almost the amount of buying that we saw as the weather markets in Europe and here in the US took hold in the spring.
Sure. Is there in general, could you say is there a fundamental story that usually accompanies that, again, going long to short, either production wise or usage wise?
Yeah, I would say that would, if you look at any sharp move in the commodity space from net long to net short, or, I'm talking about, let's just say that the net long is 400,000 in corn, the net short, record short is 400,000 in corn. So there's 800,000 contract swing there. If you're at record long, record short, and you see a move, you're either looking at a weather market, something in, a big commodity user like China having a problem, or, maybe substantial growth, COVID, those are all things that can exacerbate. And so the hard thing about using this as analysis is you can kind of get paralyzed a little bit by waiting for stories and looking backwards at things to make decisions. And that can paralyze folks, and from my experience, and really the goal sometimes is to try to find data that you find helpful. I sometimes find the CFTC to be confusing, and sometimes maybe even clouds my opinion of the market, because I'm looking at what others are doing, and it's like, why don't focus on what others are doing? Focus on what you and your farm or your current positions need to have on to protect yourself, from the bottom line perspective. And that's where this data can be good or it can be bad, in my opinion.
Yep. All right. Now, just so that we come full circle, we should talk about, the funds going the other way. Mm-hmm. If we've been tracking this and they've been short for a long time, and then we see over a series of weeks that they decide to go long, what are some of the stories, or what might be the situation that would encourage something like that, John?
Well, in row crop commodities, it's going to tend to be weather. That's the big one, especially at this time of the year. The speculators will sit around and they have computers that can read weather models, and weather models, that you and I talk about, they've already know, because the minute they come out, and they come out at a certain time in the day all the time, and they're putting those positions on, and they're not even thinking about it. It's just, this weather model says that the thing is going to be dry in South America, we're going to buy. Another story would be government elections. And I think Twitter has kind of been a game changer in this, and I'd say going back to 2014-ish, where, all of a sudden a story happens on Twitter and it gets exacerbated, and the algorithms that control the trade like weather, they'll trade like they're seeing on Twitter. So for example, the Trump election was one. When Trump won in 2016, we saw a huge swing in financial products on that night. I recall, I think silver moved massively, and some of the other bonds moved massively. Federal Reserve movement. So when the Fed comes out and says we're going to raise or cut interest rates, the bonds are futures. So there's commitment in traders on those as well. And so you might see a bet taken from short where we think rates are going to go down to long where they think rates are going to go up. And then, the market can swing on that. So, I would say earnings reports in stocks would be one. For commodity space, you look at crush. So when these crush reports come out for the NOPA crush monthly, those can be things that do it. WASDE reports, the report we're going to get here on Friday. I'm not sure when this is going to air, but the end of the quarter grain stocks and acreage report, those kind of moves are, if you've ever seen Trading Places Trading Places, which is the movie with Dan Aykroyd, that's a good example when all of a sudden the news comes out and everybody just jumps in the market because they have new data to trade. Those are times when the market can move from those net short to net long or vice versa.
Yep. All right. So I guess, so we've kind of laid the groundwork of what it is, how it operates, how we get that information. I have two questions left. The last question is it worth tracking? Because we've made kind of the pros for it. You've mentioned the cons. Sometimes you can get analysis paralysis because of this. Are the funds worth paying attention to?
I think they're worth paying attention to for the potential that can happen. As I mentioned, being record short, being record long, for me, that's helpful. But I'm going to use the gambling analogy again. You can go to the Vegas casinos and they report the same things. They'll say, hey, there are 80% of the bets being placed on the Chiefs this weekend to play the Bears. But that doesn't indicate who's going to win the game. It just indicates who they think are going to win the game. And as you know, every single report that's done on your radio station will say, past performance is not indicative of future results. And so there's no crystal ball here. And so for me, that's where I think folks can tend to get a little myopic and almost wait to make decisions to say, hey, the funds are long here, or the funds are record, they're short here. It's like, well, they can get shorter and we can stay short for a while. So, there's no perfect technical bullet that's going to predict the future because almost all technicals are backward looking. So you're going to have to use backward data to interpret the future, which, as I just mentioned, the CFTC says doesn't exist.
Yep. All right. So then the last question I have for you is, okay, so now that we kind of understand it a little bit more, understand what it is, how do we get the data? How do we put this information to work for us? How do you use it? How should farmers use this in risk management?
Well, I think you can use it in conjunction. For me personally, and I'll just tell how I use it. Everybody else is going to use it for their own ways. I use it as a way to correlate with seasonals. I kind of understand how the seasonals tend to work in the let's say the corn markets. Farmers don't tend to like to hold corn past the 4th of July. It doesn't always mean the markets fall after the 4th of July, but that is a seasonal historically that's tracked. Then you look at, we've got a record long position into the 4th of July. Is it hot and dry? Yes, that story correlates. Potentially then what can happen in the future can then move that position and change that position. Chad, it's important to note that this is a form of technical analysis. And for me, any of these indicators, what they're good for is getting you to make a decision. And folks that I've met over the longest period doing this, it's not so much whether they make wrong decisions or right decisions, it's they have hard time making decisions. It's because it's a scoreboard. And in ag marketing specifically, you have a neighbor who maybe didn't sell and you start to get there's a lot of FOMO, fear of missing out. And for me, that's all of the stuff of psychology that can really make you a bad marketer. For me, it's about making decisions and not looking back. You make decisions. Why did you make a decision? Do you feel like it was a good decision being made in the moment? Could you have been wrong in the moment? Yes, yes, yes. All of those line up. Let's go ahead and pull the trigger here. That's what I like to use them for. For me, I'm very cognizant, and I've been watching them to know they don't tell me what's going to happen. Not in the short run anyway. I think over the long run, maybe you have a little more of an edge, just given that, hey, the funds are spec long record, they potentially could come out. But I will say, if you can chart these, they all charts. And there's a million sites that have them. If you look back between 2015 and 2019 in corn, we were record short almost the whole time. I mean, we would see the weather markets move up, but then it would come right back down. And a lot of that had to do with no growth in the world and just the fact that we had a lot of excess supply in this country. So that can change. Who knows what the world's going to look like tomorrow, the next year. And so for me, it's important to remember that these aren't Bible. Don't take them to the grave. They're just an indicator.
Yep, it's not gospel, but
there you go. That's the term I'm looking for.
Yeah, but it's also, I think it's true that, it used to be farmers only had one chance to do this every year. I could argue we even have 2 times a year. We have a South American production cycle. We have a United States production cycle. And that gives us, again, more time to look at the facts, make a decision, get some risk management on for your operation. Right, John?
Yeah. And honestly, I've seen a lot of ways that guys use these as a way to trading. So give us a shout. You can reach out to me at advancedtrading.com, and we can talk about how I've seen them used. I'm not going to tell you how to use them, but there's potentially good ways to do it. When we're record long, if we, let's say, get a record long rally here into the next couple of weeks on a weather rally, for me, my eyes look to the 2025 crop year, because that's where, the funds, maybe they might have sold the crop twice by then. Who knows? But I think getting away from the front of the curve for any of you folks out there who do marketing is important. It's very difficult to trade short term. I think you have a better outlook going 18 months out. It's just a little slower.
Yep. All right, John, it's been good to have you on. Thank you so much. Appreciate the information.
Always. Look forward to talking to you again, Chad. Have a great day.
Absolutely. Again, that's John Payne. He's with Advanced Trading. Joins us on today's podcast, The Grain IQ. And again, if you haven't listened to prior episodes, go ahead and click back. We've got a few seasons behind us already. Go back, listen to that good baseline information. And again, take those little tidbits and build up that risk management plan for your operation. That's Grain IQ. I'm Chad Moyer.
Grain IQ is a production of the Nebraska Rural Radio Association with support from the Nebraska Soybean Board. It is brought to you in part by Nebraska soybean farmers and their checkoff. Grain IQ is hosted by Chad Moyer and produced by Rebel Saklocha. It is written and edited by Alex Makovica. Our project manager is Bryce Duskid. You can listen to Grain IQ on Spotify, Apple Podcasts, or online at ruralradionetwork.com.